everyone. We're going to get started here.
And I like what you said also.
Thank you for joining us for today's Lunch and Learn at Innosphere on SaaS Valuation in 2025. Today, we have the privilege of hearing from Dan Pellegrino. Dan is a seasoned partner and managing director at Forbes Partners, specializing in investment banking advisory services within software and technology sectors. With a rich background spanning nearly 2 decades, Dan has been pivotal in guiding entrepreneurs with capital growth strategies, mergers, and acquisitions. His expertise is rooted in his extensive experience, including significant transactions like Pfizer's acquisition of Wyeth. Dan holds an MBA from the University of Notre Dame and a dual degree in biology and chemistry from Baylor University. His professional journey is marked by a deep commitment to leveraging his vast industry knowledge to drive success and innovation in the middle market space. Please join me in giving him a warm welcome.
Thank you so much. I need to update that bio. It said 2 decades. I think as of this year, 3 decades is when I graduated. So, I guess that sounds a little either more impressive or just old, elderly. I don't know. All right. So, good afternoon. We got this afternoon already. It's good to see all of you guys here. I was here 1 year ago. It would be interesting to see how many people were actually here 1 year ago as well. Just so I try to make this a little bit different. Okay. All right. So as you know, Dan Pellegrino, I'm a partner and managing director of Forbes Partners, investment bank, and I have not been an investment banker my whole life. I also have been an entrepreneur. I've sold several businesses, 2 businesses. I've started several businesses, sold 1 to 2. But I've been through that process of startups and lived in that world. I still live in the world, really. I do angel investing as well, and I also talk to, I think, because of where I am, I talk to a lot of people that are young and wanting to raise capital, let's say for VC, early stage stuff, which is not what I do professionally. I actually help with the entrepreneurs to actually put money in their pocket as opposed to really giving out equity to the VCs and the angels and all these people who want a lot of your equity. So I come from a little bit of that, a little bit of bias. Love to see people bootstrap a lot of times, but I also understand that sometimes it's about getting the right resources and help just to get out there in the world and compete. So maybe the first thing I'll do is tell you a story. This is a story, it's a fake story that I made up, but it's a story that is very common, and I hear it a lot, but it's a story of a SaaS company, the person who has an idea, and they're utilizing all of the great technology that's out there, and they've got this idea that they've been thinking about for a long time, and they're finally executing on it, and they do believe that they have, and they do have the best technology out there that you can have for the solution that they're solving for, and they have the smartest people in the room, and they have the coolest logo, and they even have the coolest t-shirts and hats, and they even belong to groups like this or, frequent places like this and rub shoulders with all the best people. So this is all the people you probably already know, right? So this is that typical story. So now the only problem is that they hit some roadblocks along the way. They overlooked a few important details along the way. And one of the things, actually I named this thing Innovate Cloud, which I looked up at one point, I don't think it existed, but it probably does now, but it's made up name, Innovate Cloud. They have a fantastic software product, and everyone in the industry knew they had actually the best, most creative product out there. And I've seen this before. This is pretty common. And these guys may have even raised some, I think they did, they raised some early stage capital. They've got friends and family investors. They've got maybe an institutional VC type investor in there. The team is still, they're excited, they've got a lot of energy, and they want to take their company to the next level. And they raised quite a bit of capital, actually, at a pretty amazing valuation, considering that they really didn't have a lot of revenue, which is shocking in a lot of ways to me. but probably not to the people all in Silicon Valley, which is, a lot of times it's happened. But at some point, they grew, and they did have a lot of customers, and their investors said, hey, we think it's about time to sell. They weren't one of the unicorns, they didn't grow to a $5 billion valuation through public markets, so that's somewhat rare, but they are ready to sell, they are legitimate business. So then what happened was, they called a guy like me and said, hey, we've got a business and it's making X number of revenue and this much, and it's got all these great features to it, and we want to take it to the market to sell. We want to liquidate out, the investors want to get out, everybody wants to get out, and we'll roll some equity forward. The original founder can even stay in, he's not the CEO anymore, we've out this person for a better CEO, and that CEO, that original founder is just on, he's the board of directors. This is a very typical story. And then what happened was they thought that their business was worth a lot, and it was because there's a few strategics that they said, hey, these guys would really love our software. They would really love, it would change their business. If they had our software, they could probably instantaneously add at least $500 million worth of revenue to their bottom line, right? This is the story of this thing. So this company that's making, I'll just throw a number out there, let's say they're making $20 million in revenue or something like that, or $50 million in revenue, whatever it is. They realized that their business is sellable, but the strategics who they think would pay exorbitantly higher because they could add so much more to their bottom line. And they knew that the financial buyers, like the private equity buyers, wouldn't buy them because they just didn't really have that same profitability, and they didn't really have a big addressable. They kind of owned the market already, so some downsides to it. The big investors come in, and sure enough, they all put offers, but the way they do valuation is different than I think these people expected. They expected the valuation to be, oh, you can add $500 million, I guess we'll pay $499 million, and I'll get $1 profit for doing this deal. So that's how people think, but that's not really that's not really how these strategics value businesses. They look at it and say, this is an incredible idea, and they've got a bunch of customers that are great. If we were to do that same thing, how much would it cost us to build this same thing? We'll put all the best team together, and we'll throw as much money as possible to it, and then we'll go sell it to our own customers, and we've got way more customers, obviously, who would jump on this than they do, because we're a $10 billion company or whatever. What happens is, they value it based on a buy versus build. So they come in and say, we'll give you $5 to $7 million for this, because that's about how much it takes for us to get to exactly where you are, right? And that's how they look at it. And that's unfortunately how it works. If you're actually growing, there's a lot of other things. That's just the example that I see a lot, because I think people have false expectations, but just because of not being educated. So at the end of the day, the only reason I'm here is to give you guys a much better education on how each type of investor, buyer thinks, not the capital raise VC guys. I could talk about that a little bit. That's a little bit different. It's when you really want to actually put money in your pocket, because I would have to guess, being an entrepreneur myself, one of the drivers of being an entrepreneur is there's some creative freedom, you're building something, you're getting some satisfaction for building something from your own hands and seeing it grow and turn into something, and there's a lot of that. And I think there's other, maybe equally as powerful, not having a boss that's telling you what to do at the same time. I think I could identify with that. I don't like that. A lot of entrepreneurs don't like that. They're just trying to figure out a way to make money. But I think a lot of times people are driven by the fact that you could make a lot of the money, right? I think, especially in software, something like this, you could, you start dreaming and thinking, man, what if I had $1 billion? What would I do? So there is a drive for money. I don't think there's anything wrong with it. That's part of it. So I think eventually you have to come to terms with, if you go raise money and you raise $100 million, that's fine, but you didn't get $100 million, right? The business got $100 million, and they really just put money onto the balance sheet so you could grow. And maybe it works, maybe it doesn't. You're going to hire, I've seen people hire hundreds of people because they think that's gonna just drive the growth, and it ends up then they start laying people off after something, it kind of disappears, all the money kind of went away. VCs are looking for 1 out of 30 deals, hopefully work out, so it's not amazing, but then what happens when you really want to sell? Because when you sell, even if it's only a partial equity, selling is giving something to somebody and they're giving you money back and you're putting it in your pocket. That's essentially what you want to get to. So that's where I'm going to start with. I'm going to start with, how do you kind of think through some of the things that are going to drive growth, and what are some of the trends today that will give you, hopefully, the ability to, even if in 10 years from now, if you only get $10 million in your pocket, that's still a lot of money. How many people, I won't even ask you to raise hands, but you have $10 million in your pocket now, why are you even in here? So, that's what I would say. All right, so let me kind of go through this. So before I do, I'm okay having this be decently conversational if you have a few questions on specifically to the slide itself, but I will try to get through, I do want to get through it, and then at the end I will stay here. I have a call that I got to jump on around 1, I could probably say 1:15, I just told someone to call back in an hour. I got a bunch of deals happening right now, so it's not awesome busyness time right now. And by the way, if you have questions about what's going on in the M&A market, and investment bankers are the ones who are the front line of being able to see what's going on. It hits the Wall Street Journal maybe about 12 months later. So you'll see what's going on right now 12 months later in the Wall Street Journal, so I can tell you. All right. Okay, so let's go to this slide here. I've got, okay, so one of the most important things, like I said, is really just for an entrepreneur, someone who's starting, especially technology, this is a SaaS presentation to some extent, but you can really put it to anything that's technology leveraged with the reoccurring revenue aspect to it. So ARR, that's what everything here is based off of. There's other models out there for other tech. I cover a lot of tech, not just software. And high-tech manufacturing is another place, and that's completely different. A lot of defense-related stuff is in high-tech manufacturing, I think, and, that's all based in the United States, as you can imagine. So there's a lot of other models out there. This is specifically for SaaS software. So what I would say is, just looking at these, the main thing that, you want to know is just, what do you need to think about, right? So this is kind of the intro slide, if you will. And I'll just go through each one of these. I don't want to spend a ton of time on this slide here, but the high level, where do you decide to invest for growth, right? So the first one, emerging trends. I think it's important just to stay ahead of the curve and understand what customers are demanding. And, and I think there's a lot of things that have changed in the last year, obviously with the onset of AI as fast as it has and how cheap it is to use and leverage. But the actual value propositions haven't changed. You could probably have given this presentation in some capacity 40 years ago, and it probably still keep the same, it would be the same. There's not really that much of a difference in how people look at value. And it's not purely just about who has the best technology, and I'll talk about that. The other one, the middle one here, each buyer has a different view of value. And when I'm talking about value, it's a little different than, you got to remember where I'm coming from. I come from middle market, so it's companies that have already started making money, and they actually have a business value that could be sold in a liquidation event, which is obviously different than raising capital. We raise capital for companies as well. We're not just purely a sell-side firm, we also do buy-side stuff. But it's also middle market. So when you're raising capital, you're raising it in a different way. Usually it's for growth capital a lot of times, but it's not a early stage type raise. So I'm not in that world as a profession, but I know enough about it, and I know you guys are all, a lot of you guys are more in the early stage. So I want to make sure I'm relevant to you. So the middle one is the beauty is in the eye of the beholder, and I just say this a lot because if valuation was a science, I would see valuations much more close together. You know, I get 15 different bidders on a deal, and they'd all be very close to each other in value, and that is not the case, I will tell you every time. There's emotions that come into play here. Even the most stoic people, I can tell you, it's very emotional. You know, people, I mean, we're talking to private equity, and they're not even really the buyers. They're really a fund that's representing their LPs that are coming in and buying, and they still can get emotional and bid up on something. And, you know, you have to see the value. You have to be able to take that value proposition and put it into an investment thesis, because it's not just coming up thin air and saying, I think I'm willing to pay a 6X on that, or I'm willing to pay a 9X. That doesn't happen. Multiples are after the fact of doing the valuation. You've ever done, has anybody here, like, actually built a model to value something before? Right here and here, yeah. You know that that's where it starts, right? That's where the valuation starts, is putting a model, but you can only feed in the model what you know about the business, and the business itself and the business's model go into that. The other part, which is similar to this, is valuing software. There's a lot of different value drivers, so I'm going to hit on all the key ones. I don't think they necessarily changed too much in the last several years, but it's there is a reason why software trades at a higher multiple, and it's not, even private equity guys that I talk to don't always really know. I mean, they say, hey, we don't do software because we just don't know how, we just don't want to come in and pay all this money for a software company. We're just not in that. But the reason why people do pay a lot is because the risks are lower. The risks are a lot lower, you know, and I'll tell you why in a little bit. But that's why. Valuation is always a risk-adjusted net present value, essentially, of what you think the future is going to hold, you know. All right, so I'll flip this a little bit here, see if this works. Okay. Put this slide here. So if you take a look at this slide, this is some of the current trends that I had seen in the market. Some of these things are you're seeing people maybe adjust to, larger software companies adjust to, because they're seeing that sometimes some of these are focused on keeping your clients happy, keeping the retention. And I do think that there was a trend at one point, maybe the last couple of years, where almost every single company was trying to figure out a way to do an ARR model, regardless. I think McDonald's might have been even. I'm kidding. But I mean, just think about it. They probably were sitting around thinking, how can we get a subscription model at McDonald's? But everybody was trying to do that because everyone realized if you can have a much higher prediction of your future cash flow, then you have a much better, if you think about it from math perspective terms, a lower discount rate on your NPV calculation. And so everybody's trying to figure that out. But I think there are some tweaks here because people started getting sick of this, and if you were a company and you were using a certain software, let's say, and you were paying maybe more than you thought you should because you weren't using as much as this power user client here, there were some changes here, as you can see. So subscription model innovation, a little bit of flexibility going along with that. There's, that's essentially tailoring subscriptions to match the customer usage is one of the things I saw as a pattern happening. And then the next one over, integration and ecosystem expansion. That is really driving value through kind of enhancing the stickiness, if you will, how I would look at it, and customer loyalty. And there are some different ways that people are trying to do that. I think if you can integrate, if you can make your product be a little bit more integrated. I'm trying to think of an example here. I was just thinking of, have you heard this commercial that's on right now? This is not related to software at all, but I can't, it's always in my mind. Southwest Airlines, they're like, hey, you probably heard the rumors are true. We're going to now start allowing people to select their seats ahead of time. Anybody heard this commercial? Yeah. And then the commercial then goes like, the next person says, oh, you mean I can sit with my family? And I'm just thinking, oh my word, I can't believe it took Southwest Airlines this long to do this. And they're like, I thought the next part of the commercial was, I thought every airline allowed you to pick your seats. And they're like, we do now, you know, and it's incredible. But what happened to Southwest Airlines, is, you know, they haven't been doing so well, right? They were amazing. That was the best company, well, it's like 20 years ago, I guess. It was the best company in the world. Best company to work for, that's for sure. And they were incredibly profitable, everything. But the world passed them because they stayed isolated. They wouldn't put their flights on. If you ever noticed, you're trying to look at Google Flights or whatever, and you don't see Southwest Airlines, because Southwest Airlines insulated themselves, right, over time. So what happened was they had to kind of work harder in a different zone, which they mastered at one point, but when technology went past, they couldn't keep up. And I think that can happen. You kind of think your own software, let's make everybody use it, and we won't let anyone use anything else. But I do think it's better to integrate it with other software, because now it's easier to use, and people will use it. You just got to figure out a savvy way to make money on that. That's really the key. So that's number 2 on there. Compliance and security measures, this is becoming a much bigger deal, as you probably know. This isn't old news per se, but security is one of the things that you could be held responsible for, and you just want to make sure that you are up to date on anything related to cybersecurity threats. And if you don't have a good investment into a robust security protocol, you could be in trouble at some point, and you know, that could lead to breaches, and obviously loss of customer trust is the number one thing that you could be in danger for. So that's obviously a big thing that I think a lot of software companies, larger software companies, are definitely focused on. That last one, the over-reliance on a single customer segment, is one that I see a lot, because when you do get to the point of, let's say, running a process to do a minority recap, is what we call it, or a majority recap, where you're maybe you take the early stage investors out, you're bringing in a private equity model that comes in, and then they want to partner with you, essentially, and you're going to partner with them to go forward. That's where a lot of the big growth can come, and most people actually, who really become wealthy in this, make most of their money on what we call the second bite of the apple. Has anybody heard that word, second bite of the apple? Yeah, that's the best thing you can learn about, is the second bite of the apple. Right. And so that's where you can really make money. So that's what we get people into. We get people into a place where they can get the second bite of the apple. That's what we do. You can learn that. You can go research that on your own. But the thing that I'm trying to, the main focus here on this slide is really proving out your markets. I had a company that was 10 million of ARR and 2 million of EBITDA. So they weren't growing very well, though. They were only growing about 10% a year, and believe it or not, when we dug into it, their 10% a year was really price increasing, and that was pretty much it. And then when we had a lot of offers. They were not that great, as you can imagine. A company like that would only sell for about 2x ARR, just FYI, maybe 2.5x ARR. And we sat in the management presentations with the private equity firms, and our guy said, hey, we're the best software. They were the best technology out there by far. We're so amazing. Our technology is so amazing. It was focused purely on the technology. He said, we have such good technology that every single possible client that we could ever get uses us already. Oh, gosh. So how much would you invest in that company, right? It's great if you want cash flow from it, but it's not going to become, it's not going to triple in size. That's what everybody wants. They want to see you grow 5 times larger in the next 5 years, right? So you have to have an addressable market in multiple markets. And you can't just say you can do it, you got to prove it out. Everybody is from Missouri. Everybody's from the Show Me State, okay? I grew up in the Show Me State, and I use that because I am from Missouri, so I can make fun of anyone from Missouri, because I am originally from Missouri. But it is true, every investor out there, at least the later stage investors who are really the ones putting the money and looking for that exit, that liquidation event, they always want to say, that's great, I love that you told me that, but I want to see it. You got to show me, right? So everyone's from Missouri. I said that one time on a phone call with some business owners who were, every investor's from Missouri? No, not really. But, I use a lot of analogies. I actually said on a completely different call, a few weeks ago, I said something like, yeah, we're gonna lock arms, this process of selling a business is tough, right? We're gonna lock arms, we're gonna do it together, and it's like climbing Mount Everest, and you wanna make sure you go with someone who's climbed Mount Everest several times. Now, analogy, and they're like, you've climbed Mount Everest several times? I'm like, no, I mean, in the analogy sense, yes. Anyway, so I'll try to make sure you understand my analogies as opposed to just true, that logical, I guess, or spotlight, if you will. All right, so like I said, I think a lot of people are driven by creating something new and cool and really providing, maybe a good career for people, maybe for yourself as well, for people around you, and then ultimately creating substantial wealth for you and yourself and your family, right? And then, but the ultimate cash out occurs typically in the middle market. That is where it comes from, just so you know. So if you did math and you were a logical person, you would do some math and you'd look at this, and I'd say, I'll give you some stats here. As you're just looking at this is just some data for you, but these are some stats that are not on the slide. So 90% of all SaaS software companies will go out of business at some point and not make any money, material money for their founders or investors, okay? 90%. So that's pretty high. The other 10%, so let's say you had 100, 900 or 90 of them are gone, and now you got 10. Of those 10, 75% to 80% of them will sell through a guy like me in the middle market. And that's who I see. I see people who have come through and say, hey, I built this thing, I've done it for 8 years, 12 years, whatever the number is, and I'm doing pretty well, but I'd love to take this to market and run a process and sell this thing. And then, sure enough, we sell it, $50 million, $100 million, $200 million. Our size range is probably our sweet spot is probably 50 to 500 million. We do smaller and larger, but that's kind of the sweet spot where we fall.
Revenue or transaction?
Sorry?
Revenue or transaction?
Transaction, enterprise value, yeah. Enterprise value. So I've taken a $2 million ARR company and sold it for $20 million. Okay, so it's, you can get a, pretty good multiple in the middle market. Now, granted, if you're out there raising early stage money, you might say, oh my word, I had a, $1 million and I get a $100 million valuation. Well, that's not real, okay, just FYI. But that's kind of how you have to do it in the early stage world. The real valuation comes when someone's willing to actually put money and take your company for you. You take money out the door as opposed to putting the money on the book. So just keep in mind that my numbers will be different than what you see when you're raising early stage capital. Okay, so you can still stick with your early stage capital philosophy of how you value the company, but I'm just going to tell you about your exit when you really want to make the money. So, like I said, 10% or 75 to 80% of that 10%. So that's about seven or eight companies out of 100 software companies that started will be able to cash out, and those can range. I mean, sometimes it's some for $5 million and they call it a day. Sometimes it's 100 million, 200 million. It's all over the place, but it just depends on how big and how fast you're growing. We'll walk through some of that stuff here in a little bit. The other 2-3 businesses of that 100 will actually exit through an IPO. And an IPO sounds amazing, doesn't it? Well, not all IPOs are amazing, we sold a deal that went through a SPAC IPO situation, and he ended up, a lot of the stock is restricted, there's some other stuff that goes along with it. His value, I'll just tell you the value of the shares. So it was $10 a share is how they went to the market and into the listing on the exchange. And then when his stock and shares were not restricted where he could sell, they were only worth $0.25 per share. So that's common, that's common. So just because you go IPO doesn't mean you're going to be wealthy. In fact, only 1/3 of those 3 people, so only 1 out of 100 will actually make what I would call a material exit through an IPO. So it's kind of a lesser, attractive way to go because the odds are against you. But I do understand, especially if you're 23 years old and you have a really cool idea and you're just gung-ho, you're gonna tell me what every person says is billion or bust, baby, billion or bust. Like, even if it's a 0.005% chance of making $1 billion, I am willing to do it. Because I came up with this idea when I was in college, and I've got 16 other ideas, you know, that I'll do when this one busts. So I'll just go do them, and I'll just keep doing that for the rest of my life. Well, ideas are worth nothing, you know. It's like, reminds me of Jerry Seinfeld, the Seinfeld episode where he goes to the rental counter to pick up his rental car, and he's like, I'm here to pick up my rental car. He just arrived to wherever he was arriving. It's with Elaine and George, and they said, oh, I'm sorry, Mr. Seinfeld, we don't have your car. And he goes, yeah, but I had a reservation. He goes, well, I see you have a reservation, but we don't have your car. And he goes, okay, so you know how to take a reservation, but you still know how to hold the reservation. Yeah. So it's kind of the same thing. It's I actually lost my train of thought of why that analogy worked, but it's ideas. You know what? Ideas. Yeah. Okay. Ideas are. Everyone has ideas, right? Everyone has ideas. I've got ideas. You guys have thousands of ideas, but that's not where value is created. Value is created by getting people to pay you for those ideas, and not capital raising pay. I'm talking about your customers paying you. When your customers start paying you for your ideas, now you know that's a good idea. Well, actually, that does not dictate whether it's a good idea. That just dictates now that you start making value, you start to create value for your business. Because before that, you don't really technically have a lot of value. All right, let me go to this next slide here. I want to make sure did we start at 12? Because it's like 12:45. I feel like I just started. All right, so this right here, let's just walk through some of this data. So this chart, what you might see, this is median revenue multiple by size. And so you might think, interesting that smaller businesses sell for higher multiples than bigger businesses. And, you know, and I think you should always ask, anytime you see data, you should always ask, okay, well, why is that? And then whenever they give you the answer to that, you should say, well, why is that? And then whenever someone gives you the answer to that, you should say, well, why is that? Because if you're not doing that, you're just believing the data. And the Mark Twain thing that says, you know, you have lies, damn lies, and then statistics, and it's kind of the same thing. It's like you have to really understand what's going on behind the data. And I'll tell you, 99% of our world population doesn't, or at least the United States population, probably does not do that. Here, I can tell you the reason why that's the case is because these are highly correlated. If you do enjoy statistics and you want to see how things are correlated, it's highly correlated to growth rates. And growth rates are easier to be done on small businesses, right? It's harder to grow a $100 million business by 100%. That's harder. That's pretty hard. But you could grow a $500,000 ARR company by 400% possibly, you know? So it's growth rate. I'll show you that. That's what I want to show you. So let's keep going through this. Okay, so this is also a good slide. I think this is probably the most important takeaway, if you're thinking about it, is that, and the blue bar represents the 75th percentile and the 25th percentile of the range of multiples. And this is the median. So if someone just looks at the median, you're missing out on a lot of other data. You want, and even the 25th, even the 25th to 75th, you're still missing out on a lot of tails, right? So you could sell your business for 1x. You could sell your business for 0.8x. You could sell it up here. You could have sold your business for 45x. I mean, there's a range of values in software companies is really insane. And it's because of the variables that go into it, which I want to walk through. So I'm going to kind of speed up here a little bit, just so I can answer your question. The biggest question I think and the reason why I even put this whole thing together a long time ago, this is a couple iterations of it. I've got to make an updated one here pretty soon, probably. It's just really busy right now. A lot of people who I talk to, especially software owners themselves, or even advisors to software businesses, really had no idea what drove their value and where they would fall on a multiple perspective. They just said, well, I heard somebody sold their business like mine for 18x ARR, so I'm better than they are, so mine must be at least 35x, you know? And that's kind of that's how the logic goes. There's a lot, and by the way, I'm not even gonna get into this at all today, but there's a lot more that goes into, I sold it for 12x. It could be, well, I'll give you a 2x today, and I'll give you the other over the course of the next 20 years. I mean, that's different than, you know, I'll give you all cash today. So structure dictates where you fall into that spectrum of valuation as well. And, you know, I think everybody wants all cash up front, but that's not always the best case, because remember, the second bite of the apple is really good. So don't forsake the second bite of the apple. I'm not gonna talk about that yet, believe me. All right, so continuing on with this, let's go to that next slide here. I want to make sure we hit on some of this stuff. This is interesting because this looks like the multiples in software businesses are going down. That's what that would look like, right? To someone who doesn't have the ability to ask why.
Yes.
Right? But that's not true. This is not true. That is not true. I mean, that's all factual information, but software multiples are not going down. The deals that got done, we're selling at a lower valuation, but that's because we're only taking snapshots of the deals that got done. And the deals that got done in these orders here, I mean, those deals keep getting worse. They're not growing the same. If you look at the data, I think I might have the data in here, but if you look at the data, the growth rate, I think I told you this, the number one driver of where your value would lie is your growth rate. That's the number one. There's a lot of drivers, but that's number one. If you just correlate the average growth rate of that category, average growth rate, that growth rate is going down. So what you're doing is you're seeing worse businesses. You know, businesses are still sellable, but they're just not as good. You know, they're growing at an average rate of 20% versus 45%. So if you think about it, if growth rate's the highest correlator to the value, then that's really what's happening. So multiples didn't change. If you had a 40, remember, there's outliers in all that data. If you had a deal that was, if you had a software company that was better than the average growth rate here, you were selling it for greater than that average. Because the multiples, I thought, actually might have been going up, but everyone thought they were going down. But that's just because your business wasn't doing so great. You know, that's really what happened if you dig into it. All right. Here, I think I've got some of this data here. Like really well, elderly eyes. So this here is I think this is the proof in the pudding. You know, I think personally, this is my, you know, just seeing the front lines. I'm on the front line pushing for valuation, putting models together to show these equity groups that they need to pay the most possible money they could probably come up with. And I do think there's a law in economics. There's a law, and do you, anyone know any laws in economics? The laws of supply and demand? Yeah, it's not a theory of supply and demand. It's not a hypothesis of supply and demand. It's a law of supply and demand. And that dictates a lot, and it also dictates how much your business is worth, right? I mean, you can't get around it. Now, granted, there are some caps and there's some baskets, because the basket would be generated by, why would I sell my business for that low? I just keep it and make money. Like, why would I sell for that low? So there's some baskets that kind of push up against it. And on the high side, you get to the point where it isn't as money. If someone's money, if you're an investor with money, it's, you're saying, why would I put all that money into that? I can just go buy this and make the same kind of return. It's a lot safer. You know, it's a lot less work. So there's caps and baskets that dictate it, but that supply demand really is what drives it. And I do think that I would say, over the last several years, there's a lot of software deals out in the market, and there's a lot of money that's still looking for software deals. I have calls with private equity all the time. Where's our software deals? Where are they? They're not out there. They're not coming to market right now. And I do think there's some other things that are dictating that. I do think private equity sometimes is a little bit behind the curve sometimes in knowing what's going on in the world. And I'll talk about that actually. So that even, you know, and so look at some of this stuff that's written up here. Investors value revenue growth more highly than margin growth. This is what has, you know, they've done research, McKinsey's done research, and then there's some other research here about just the amount of money. If you think about supply demand in this market, it's, the supply is how many businesses are out there for sale. Demand is how much money there is that wants to invest in those businesses. So that's the supply demand. There's more money in private equity now than I've ever seen, and it just keeps growing. It's incredible where it comes from. So, real quick, let me go to the next slide here. This is kind of a good slide to really show you kind of how I might do evaluation for one of my clients before we go to market is the bell curve, because you can't just say, oh, your business is worth $45.6199. You just cannot say that, right? But we're going to go to market, and we're going to go out to 500 groups that are looking for you, that we know about. We're going to go to 500 groups that some of them are going to be strategic, some of them are going to be pure private equity, and some of them are going to be strategic backed by private equity. And some of them might be family offices, although there's not as many out there that would do deals like this. And then we'll get a range. We'll get a range of offers. And I can tell you that, and this goes back to the science versus art side of things, is that I can just name every deal. And I have a deal right now that does payment processing technology platform. And they're not really an ARR, but it's a residual model, so they're getting a little piece of all these transactions. So when you go to the coffee and you buy a $3 coffee, you pay with a credit card, there's a small little fee, and that fee gets divided up between about 10 different companies. And they are one of them. So every time someone buys a cup of coffee, we get 3 cents. It's amazing, or probably less than that. But they actually make $200 million a year in revenue doing that. And they make $20 million a year in profit, which is really great for them. Anyway, we just ran a process, and we're having management presentations this week. So I just left the management presentation, came straight up here, and I'm going back down for a dinner that we're having with another investor group. The offer ranges. We got an offer at the low end of 50 million. We got some at 60 million. And first of all, I don't even understand why you want to pay 50. Like, how could you expect us to take $50 million offer when they're making $20 million a year in profit? Like, I just don't understand it. And then we've got a little, smattering that are kind of in that 120 to 150 million dollar range, or maybe 100 to 150 million dollar range. There's several, and then we have one that's up at 190 million, and you just wonder if it was a science, why did this person? And they're all like Harvard, they're all private equity groups, right? So these guys are all like from Ivy League schools, they're the smartest ones out there. But why did this group, it wasn't even a person, it's a group, right? It's a company. How do they value it at 50? How do these people, and none of them are strategics, by the way. Strategics couldn't wrap their head around it. They're like, I don't know. I always say this when we go out to the month, I say, look, you need someone who knows enough about your business where they're excited and it makes sense to them, but you need them to be naive enough about your business so that they'll pay the highest possible price. You don't want someone who's an expert in your business to be buying your business. They always have a negative attitude toward it. I always see like these, oh yeah, it's not as good as you think, They just have kind of a negative attitude, and so they don't bid as high. So everyone thinks strategics are going to come in and save the day, but it's not going to happen. I don't see it happening that much. This is what we put together. This is kind of the meat of this whole presentation, let's say. This is kind of how I would look at a software company. I would take this and I would make this bespoke to every company. Not every company is going to be exactly these, right? There's other things that drive value for each company, and that's where the human part of this, I think, comes into play. And I want to know about each of these categories, and I want to figure out where you are on the spectrum. And every company has stuff that's over here on the left-hand side that they're not doing very good, and every company usually has something that they're really good at, especially if they're making money. If it's a company that's doing well and making money, they're going to have something. They're going to have something on the right-hand side that pushes them up there. These are ordered in roughly the highest impact driver to the lowest impact driver of valuation, but they all still feed into the valuation. And I like to put it in a visual format because it's kind of like your company's thumbprint. And it's also kind of like, I could look at this and go, okay, I think you're going to be you're kind of be a premium, company, It's maybe, I don't know the analogy to this, like you're in the NFL draft and you're looking at these people come through and you're measuring how far they can do the broad jump, how many push-ups they can do, how fast they run the 40. You're putting all that stuff together and you're kind of saying, hey, this is an incredible athlete. They're, way over here. Let's draft them because they'll turn into the best receiver out there, or whatever. That's kind of what this is, right? They're looking at this and saying, okay, look, their growth rate is really high. Their ARR is X, depending on where it lands. You've got all these things are financial. Some of, all these things kind of relate to, I'll get into this, but they relate to these three really pillars that we look at as far as what drives the value. So, and I know it's almost one, but I'll keep, do you guys have time? I could probably call this person back in like 15. If you guys are okay. Keep going. All right, so, this is how I would look at things. And now, the GRAM, I want to talk about GRAM real fast because GRAM is an acronym that I came up with, and it's probably, I don't know if it's a good acronym, it sounds like grim, like it's not good, but it's GRAM, it's principle. But it's like based on the rule of 40, so it's growth rate plus EBITDA margin. So growth rate, GR, and then EBITDA margin, EM, so it's growth rate plus EBITDA margin. But it's got a twist on it based on the research that I've done. So I did some research and I found that you can't just take the growth rate plus the EBITDA margin and add them together and have it's good. You can, it's a good measurement to track, but it's not as highly correlated unless you put a little tweak into it. So what I found is that growth rate actually has about double the impact than EBITDA margin. So what I do for GRAM is I'll double the impact of the growth rate and I'll multiply it accordingly and then do the EBITDA margin accordingly and then add them together. And that gives me a much higher correlation between where this might end up on the spectrum of premium versus non-premium. But you got to bring other things. Like I told you the story about the addressable market. They own the entire market. There's nowhere else to grow. So obviously that one, I don't care how good their EBITDA margin was or their growth rate, they're going to get a low valuation. So there's a lot of things that can pull you down here. All right. So real quick, I'll just kind of go through these three pillars that I put together. Capital efficiency, market demand premium, and certainty of continuity. I think you can almost take a lot of these little KPIs and put them into these buckets, and these are the things you could kind of measure and say, hey, where are we in capital efficiency, where are we in market demand premium, and where are we in continuity of, certainty of continuity. So as we look at these, I'll look through each one real quick. So capital efficiency is really how efficient is the use of your money that you have. Like you take in a sale or take in some capital and you sell your product, let's say you get some money. How much does that churn? How quick does it get to another sale? How much profit optimization? It's almost like an ROI almost way to look at things, but it's how efficient your money is. And if you're an investor, I want to look at this. If I'm investing, I want to say, hey, if you're going to get $1 million, how much are you going to turn that $1 million into next year? Are you going to turn it into $5 million? Because I've got another company I want to invest in that can turn that $1 million into $20 million. Which one would I put my money? I may still put a little bit of money here, but I'm going to put a lot more money over here. So that's kind of the way to think about it. LTV, some of these are old school, LTV to CAC ratio, which I think there's been there's been some kind of marketing twists on that, if you kind of are keeping up with some of these KPI ratio things, but it's still the same thing. All you're looking to do is figure out if it costs us $100 to pick up a customer, and I want to know that true cost. It's not just my marketing dollars through ad spend, it's also my salespeople, it's the whole thing. How much does it cost for me to get this customer aware of my product and buying it and paying me, right? How much is that? You can really dig into that because I started a software company once after we were running it, and it was incredible, cool technology, that, a friend of mine built, really, and we both together went, and we realized that, man, it costs us, $20 to pick up a customer, and they really, once, their lifetime value is only about 75 cents. And so I thought, and the first thing he said, well, can we make it up in volume? I said, no, we're gonna go bankrupt if we keep doing this. So we shut the business down, actually, and that was a smart move. It was a good move not to lose money. But that's the way you gotta think about it, right? All right, so the next one is market demand premium. That is more about, that's where I kind of talked about that total addressable market and the growth rate, and customer retention. You're just trying to figure out what the demand is for what you have and who you are and what your brand is. Because one thing that I think a lot of people think about, especially in the tech space, is they really only think about how cool their technology is, and that's what's gonna drive their market demand. And it's not, if you build it, they will come. That just doesn't work. It's you have a brand, you have a promise. People will trust you over somebody else, hopefully, because not just because of your technology, but other things. You know, there's a lot of other little things that go into that. And you see this all the time. I mean, I always tell the story of, it probably doesn't even resonate with half the people in here, but like VHS and Betamax. You remember them?
Yeah.
You know, so I remember just being a kid. I was a kid actually, but you know, VHS. Everybody was using VHS, but all these people were like, no, I'm a techie snob guy, and I only use Betamax because it's so much better, the quality's better, things are smaller, and all these reasons for it. But VHS, they went out of business. VHS made it, and why was it? Only because they were able to get more of the adoption of everybody. And everybody kind of wants to be on the same thing, you know? You could come up with a really cool new clock that uses completely different time and different symbols on it, and that would be super awesome. But are really people going to use it? I don't think so, because we need to use this. Everybody in the world uses that clock right there. We know how to use it. So adoption and market demand adoption is really important here. And really, at that point, it's all about scaling by growing through getting customers to use it and stick to using it. That's the most important thing when you're trying to build a business. And then once you've done that, you can now you can measure stuff like lifetime value. You can measure stuff like and lifetime value can kind of fall into this too. I say that, but you're looking at your ARR and the magnitude, and you're really just looking at what is the certainty of my cash flow in the future. So let's say I'm an investor, you're an investor, and you want to invest. You've got to invest in one of these two businesses. One of these businesses does really good profit margins, they make good money, but they're essentially building something, and they're selling that one thing. And it's some sort of, let's say it's a consulting project or something like that, and they have to go sell their consulting wherewithal to whatever company and say, hey, buy my services, and it's a 6-month project, and we're going to make a lot of profit doing it. So they do it. And so every single time they have to remake their revenue. They have to go out there, resell their revenue, resell it. That's tough. That's a tough slog. That's why consulting companies will sell at a 4 to 5.5x multiple, right? That's just unfortunately where it's seen, because you have to go redo the revenue every single year. Whereas if you buy a software company, I might be able to just fire everybody. I wouldn't do that. I mean, we wouldn't do that. But let's say everybody left, and we just said, hey, let's just watch this thing. You could still collect paychecks, probably for 20 years, possibly. You know, so that's why the risk level on a software company is so much lower. But that certainty of continuity is what drives that multiple. You know, I feel more comfortable knowing with a higher degree of certainty how much I'll get in the future. Real quick, valuation is, like I said, it's not a science, it's a science, but it's also an art, and there's a lot of other little things to it. And it's very important, really, just to know how and what drives this and how the perception of the ultimate investor / buyer is. But it's not purely what drives you. The reality is, if you focus purely on why your customers are willing to pay more and why they're willing to stay, you're going essentially to be focusing on building value in your company. And that does, the secondary piece to that could be technology, right? If your customers are saying, I really want a way to do this and this, you can solve that through technology, but technology in and of itself doesn't have a value. But what does have a value is if your customers are willing to pay for it. So that's the thing that everybody's looking for. They're always looking for the proof in the pudding. You know, don't tell me, show me. Everyone's from Missouri. All right, so in summary, this is my last slide, I think. I believe that you should just always, no matter what business you're in, even if you're starting a coffee shop or something like that, you should always keep the end in mind. At least know what your outcome could be and what might drive you to that outcome. And your end could change. You could change your mind. That's fine. But if if you're not thinking about anything, you don't have any direction that you're going. So I think that knowing this stuff are things that are important to you, to all of us, they should be. And I think at the end of the day, I would imagine that you probably, if you do have a business, you probably at some point want to get some of the money and put it in your own pocket. Because that's important, I think, for entrepreneurs. That's what really drives innovation, is that desire to build something really big and awesome and helps a lot of people, but also you get rewarded for it, you know, and it's awesome when you do that. All right, so that's pretty much it for me. I'll stop there, and I'll just get questions I can answer. Yes.
Curious on my part, so how do you see the current bout of session, whatever you want to call it, with artificial intelligence affecting these calculations?
Yes.
I say that because I just had a discussion with a business guy who said, well, we need to be able to, you know, figure out the market and contacts and how to, and he's developing this whole thing. He's going to put a team on it. I said, give me 10 minutes. And I was able to validate it, because I'm very skeptical about some of the stuff that AI produces. But it didn't take me very long, and all of a sudden, this big effort that putting together was like, well, here's your answer. I'll email it to you in a PDF. And so I get this, so anyway, you can see in some cases where these technologies are impacting markets in ways that are kind of unpredictable.
Yeah. Yeah, absolutely. I'm glad you asked the question, because I was going to talk about AI and I completely forgot.
Can you summarize?
Yeah.
this question?
Yeah, I think the summary of it is how if you're looking back at this, and I didn't necessarily pull AI into the equation on this, and I will say that AI has caused a lot of different things, and I'll walk through that real fast, but it doesn't change how people look at valuation. That's the one thing. But what it does do is it helps you it's a double-edged sword. It helps you to create a solution much faster than it did before. I saw a deal, and this was about a year ago, so this was not, you know, we kind of knew what was possible with AI, but a year ago, think back a year ago, wasn't the same as what it is today. And this VC group, and the guy who was on the phone was the founder of Cognizant, if you know who Cognizant is. So he was on the phone, and then the founder, and he was the VC investor, and then the founder of the business was on the phone. And they spent the 3 years prior trying to build an AI tool that was able to do much quicker and more efficient background checks. So that was their product. And this guy from Cognizant, 2 or 3 years before, 3 years before that, had invested quite a bit of money into it with his VC group. And now they were looking to sell. And so they came to us and said, hey, we'd like to sell, but we passed on the deal for various reasons. But number one was, I said, man, what this guy took 3 years to produce, I think he could probably do it in a couple weeks now. And he didn't really have a lot of revenue coming in yet. And so to me, the revenue is what proves out whether you have, it doesn't matter about your technology. So it's the double-edged sword. The AI can help you get better technology to your customers faster and better, and you should absolutely use it. But that's not what's going to help you win. That's not what's going to drive the value of your business. The thing that's going to drive the value of your business is the ability for you to get those customers and keep them. And that didn't change. If I said that 40 years ago, it would be the same answer. Anybody here remember 40 years ago? If you're old enough, would that have been the same truth? Yeah. So that hasn't changed. That's still always going to be the same. But AI can help you with that. AI can help you and it can hurt you, because the way it can hurt you is that now you had a really cool idea, and so now Now, all the other 50 billion people that have the same idea can do it, so much easier. You know, like, tell me your idea, I'll do it tonight, you know, I mean, that's worthless, right? What's hard? What's really, really hard? Going and get customers to use your stuff and pay you for it and stick with you. That's the hardest thing, and that's what people pay for. So yes, we can talk about AI forever, but that's the biggest thing that I've seen. The other thing is I do think, because there's a lot of uncertainty in, you know, older software that may be trying to adopt and pull AI into their solution now, which is not really what's happening now with any software company. I think private equity, I do think they're a little hesitant right now. Last year, a lot of people thought multiples were down and not going to market, but I think private equity is still really bullish in making those acquisitions and investments. This year, I think they're hesitating off. They're still looking. There's a lot of money. They have to put their money up. But they're saying, are you going to be disintermediated in next month or 2 months from now? They don't even know. Well, nobody knows, because you just don't know. And I've seen a lot of even the software that we use internally at Forbes to do deals, like CapIQ and some of these other big, $30,000 a year licensing fees. There's companies coming out all over the place. They're like, hey, we've got that same product now, and it's only $2,000 a year. But that is a big, why would I not do that? Why would I not jump to that other one to save $35,000 or $33,000 a year? So there is some big disruptions that are happening, and I don't think people are gonna do a lot until they see how that dust settles. So, you know, I do think margins and commoditization is gonna happen at a much rate in the software space, unfortunately.
You see that affecting the stickiness that you talk about, because,
Yeah.
you know, in healthcare, everything was stuck with what they had, and now you're seeing a lot of new entries with compelling values that is disrupting the stickiness of you keeping those patients in your.
It's exactly true. That's exactly what it is. It's affecting everything. You have a lot more competitors, so, and they have better products faster. Their cost structure might be so low. It might be one person who created this thing, you know, and they can charge, they're like, hey, I can make $500,000 a year, and I just created this thing real quick. Why wouldn't I do that? And then companies themselves, when they do switch, when they make the switch, they're not going to willy-nilly just make it to some company that might go out of business too. So they do want to see that you're substantial enough, you're credible enough. So I do think brands this is another thing that has not changed for 100 years. Brand is important, and your credibility, and what a brand is it's your promise. It's your promise. So what's your promise? How credible is your promise? How valuable is your promise? So that's important. Build your brand, build your promise, build your credibility, because that is what's going to keep your stickiness. That's what's going to make people not jump from your software to another software. But you still have to, you know, give the customer what they want, and that's where you leverage technology. But it's pretty easy. Pretty easy to do, right? So there's no excuse for a bigger company to fail, although they probably will. Yeah.
So suppose I'm a company and I'm along the growth spectrum. Why would I want to talk to Forbes partners? Why do you guys stand out? When would I want to talk to you?
Yeah, so Forbes, we're a middle market investment bank, and so if you're a middle market company, 99.9% you're going to talk to some investment bank to do the things you want to do. Now, when do you do them, and what are those things? So let's say that, and when I say middle market, we'll do capital raises. The lowest we'll go on a capital raise is $10 million. And and you've got to be able to justify that with your valuation. So it's not like an early stage type of deal. Let's say it's a company that's pre-revenue or whatever, and it's an idea, and you're just getting a bunch of investors coming in. You might be able to get a valuation, let's say, of 50 million, 100 million, or whatever the number is, but that doesn't really mean that your liquidation valuation on the market will be that, right? So they're kind of expecting, they're saying, hey, I'll put my money in, I'll give you the valuation now, but I'm hoping, and I'll get a preference structure, but I'm hoping that we'll sell this thing and I'll get money out of it. Let's say you move to the middle market where now your business is sold. So I would say from an ARR perspective, it used to be 5 million, was kind of 5 million ARR was probably the bottom line, but I would say, you know, you're probably somewhere between 3 million, you know, maybe even two. Like I said, I had a $2 million deal that we got up. I'd say, to me, middle market would start at like a $20 million valuation. And so that it was growing so fast, it just depends. I would say, what do you think you're going to be at the end of 2026? And if you are over 3 to 5 in ARR, then you're middle market, and you should not be raising early stage capital. You should not be taking money from early stage capital because it's way too expensive. And then that's where do you need capital? Do you want to raise capital? Okay, well, we'll raise capital for you, and we'll do it through the institutional world. There's just, the way I describe it is it's kind of like playing a sports game, right? So the early stage, let's say, is playing baseball, and when you get to what we're doing is playing football. Granted, you're both trying to score more points than the other team, they both use balls, you're throwing balls, there's a lot of similarities. But if you try to apply baseball rules when you're playing football, you would look silly, right? So someone who's an expert at that cannot, I know Michael Jordan was an amazing basketball player, and he tried to play baseball. Do you remember that? Yep. And he wasn't as good. He couldn't even make the major leagues, right? So, but he was the greatest all-time basketball player, right? So there is a difference. You're playing two different sports. My sport is the football. When you do a capital raise, it's a completely different process. We're going out to multiple groups. We're putting a sim together. It takes, for capital raises, it's probably about 4 to 8 months or so as a process. And we're getting the money typically from one group. One group makes the investment. It's not compounding a bunch of small stuff. And then with a sale of a business, that can be a minority sale. So you could sell, let's say, a minority share. And when we say recap, that just means your money going out of the business into somebody's pocket. So you could say, let's do a minority recap. Maybe you're just taking out early stage investors and they're getting their cash out and you're keeping your equity in. Maybe take a little bit off just to pay off your house, whatever it is. Majority is the same thing, but just the majority of your company is what you're selling. And what you roll forward, there's a plan that these private equity groups have, and you're gonna team together and go through this plan, and 5 to 7 years later, they're gonna sell it again, and that's the second bite of the apple. So whatever amount you put in there, usually you can get more back on the second bite of the apple than you can on the first bite of the apple, because they will ensure that they're going to get the returns that they're looking for. That's the only way they raise money. And they've got billion-dollar funds, so they're very good at that. And they don't come in and operate a company either. They gotta make sure that you're good. So you gotta sell them on yourself too. That's a big sale. We gotta do training. We do training on that as well with our clients to help them make sure that they're, they know how to say the right thing and they're not answering questions in a dumb way. Yeah. Backfires. Did that answer your question? There's a lot to do.
That did, and just one last thing, if you don't mind. Yeah. Why is Forbes better than any other market?
Well, it's hard. It's a good question. It's hard. The reason I went to Forbes in the first place, I moved from California. I moved here, and I just asked people. I said, "Tell me the top 3 middle market investment banks in Colorado. I'd love it now." The only one that was on everybody's list was Forbes, and I was talking to attorneys and accountants and consulting people up there in the world that are possible referrals. So I said, okay, I'm gonna go find out who these Forbes guys are, I'm gonna join them. So I did that. And we do things a little bit differently. We put 2 senior people on every deal, whereas your typical investment bank has a producer, like managing director person, and then they have a VP person. Vice president sometimes sounds like a higher level than the managing director, but it's actually not in the investment banking world. But the VP will run the deal. They'll be the point person on the deal. We don't have a VP level in our firm. We have 2 senior people and then 2, what we affectionately call the bomb squad, which is like the junior staff. And we put a bespoke team of 4 for every deal. And that is very different than your typical investment bank. I do think it gives us better results. I think it gives us better results because if someone's out, you've still got someone who can focus on things. We put a lot more, we're more of a white glove, high touch kind of group as opposed to a retail turn and burn group. So we're pretty selective in who we would work with. And then the other thing I would say, and this is not a reason why we're better, but this is maybe the fruits of our labor better, is that, and I don't know how to rank middle market investment banks, and I don't know how you would ever do that, but there are these partnership programs from all of the big Wall Street investment banks, right? Goldman Sachs, UBS, Merrill. They all have partnership programs. They want to vet out the best middle market investment banks so that when they get a deal that's too small for them, and too small for them to be, $300, $400 million, $500 million, it's too small for them. So they have something that's too small for them. They want to still get rewarded for that because they brought it in. So they want to hand off to the partnership partner runs the deal, and then they get a piece of that, you know, the commission, not commission, I should say, that success fee, if you will, at the end of it. And so Forbes, we are in, I think almost every single partnership program. It took us a long time to get on them. And some of them only have 8 groups in them, you know, it's like UBS, Merrill Lynch, Goldman Sachs does not have a formal partnership program, but we're in the informal partner, Baird, RBC, Stifel, Harris Williams, all those, they send referrals to us all day long. I'd say we get like 3 to 5 a week from those guys, but some of them are bigger. Merrill Lynch has the biggest one, and they probably have about 40 groups in there. We're in that, and then UBS has 35, but they say they're gonna cut it down to 18, and then we made that cut, so we're good on that. So, RBC, they set up a program just, I wanna say like 3 or 4 years ago, and we were the first ones that they accepted in their group. So, I think that speaks volumes of our firm, actually. And we're headquartered here in Colorado. We have an office in Salt Lake City and Charlotte, but this is where our headquarters